Most companies think about a bad debt loss as something that impacts the income statement and profitability. However, bad debt also affects cash flow, and I want to use Klarna as an example of what can happen when customer bad debts can affect cash flow in months going forward. So let's talk about Klarna. Klarna customers shop on the site and set up flexible payment options to pay for products. And simply put, this is a buy now, pay later company with over 100 million users. They sell over 1 million products, and they have a really attractive user-friendly site experience if you want to go look. But let's look at the small print at the bottom of their homepage. A $1,000 purchase might cost over $173 over 6 months at an APR that's nearly 14%. Rates could range up to 35.99% APR based on creditworthiness, term length, subject to credit approval, all the usual things we see. So borrowing on Klarna is not cheap, and it's not a surprise that some customers can't make the monthly payments. And because they can't, Klarna has a bad debt issue. So according to NBC, Klarna's customers are having a harder time paying back installment loans they take out with the popular service. Net losses doubled in the first quarter. Consumer credit losses swelled 17% in the first quarter from the same period early, hitting 136 million. So losses in the income statement are bad, there's no question, but bad debt losses are also a cash flow problem. That's what I want to illustrate here using a cash flow roll forward. This is a simple tool that businesses use to project cash flow from one month to the next. So if you can imagine this flow from one month to the next, down the list, starting at the top, back down. So here are the components for the month of August. The beginning cash flow balance is 340,000, which is the ending July balance. Money going out for inventory purchases, and then money coming in. And what I say here is that sales on account, meaning accounts receivable, 80% collected first month following the sale, 20% the second month following the sale. And if you want to take some time to look at it, I've created color coding so you can see how that flows. And then finally, cost of goods sold representing 65% of sales comes out as a cash outflow. Here's the ending cash balance. Now let's assume that bad debts reduce the amount of cash inflow. So changing the example. Let's say instead you collect in August in blue 70% of sales in the first month following the sale. That's 360,000 and 210,000. 10% of sales in the second month following the sale, and the remaining 20% is uncollectible bad debt. So I restate the new circumstances here at the bottom with the caveat that we're collecting a little less money in month one, month two, and 20% is bad debt. So here are the changes to the cash flow. Sales on account in red declined from 240 down to 210,000, or $30,000 decline. That's the only change that I have in August, which also means that the ending cash balance declines from 485 to 455. That's where the other $30,000 decline in cash comes from. It comes from the fact that we've changed the assumptions of what we're collecting. So that's the difference between the two reports. And here's the bad news or worser news as you move forward. If the percentage of borrowers who are not good credit risk stays the same, this problem, bad debt expense, can continue into future months. And at some point, the company may run low on cash and have to borrow funds or raise equity to maintain operations. So what's a better solution? Tightening up lending practices so you lend to fewer customers who are a bad credit risk. Just to restate, bad debt is a profitability problem and a cash flow problem. To avoid these cash flow problems from bad debt, you can ask people for deposits, and you can also tighten up your lending practices. Or if somebody runs late, maybe you don't do business with them again. But these are ways to tighten up the credit practices, reduce bad debt, increase profitability, and also increase cash flow.